Hello, everyone. Welcome to our latest Sifted Talks in partnership with SEON. I'm Tom Matsuda, Sifted's fintech reporter, and I'm super excited to be moderating this very topical talk on scaling up without compromising on fraud controls. Um, in many ways, this conversation couldn't be more timely. Just 3 weeks ago, the FCA imposed a £21 million fine on Monzo Bank for inadequate financial crime controls, which revealed how the challenger bank had onboarded customers using implausible information, such as customers using well-known London landmarks, such as 10 Downing Street, um, as an address. And that followed October's 29 million penalty against Starling Bank, where the regulator found that the bank's automated screening system had been screening customers against only a fraction of the full sanctions list since 2017. Interestingly, both Monzo and Starling's troubles, they stem from a similar root cause. Their financial crime controls failed to keep pace with explosive customer growth. And yeah, both of these cases highlight a critical challenge facing our industry. How do you maintain rapid growth while building robust fraud defenses? And thankfully, we have an all-star panel with us today to answer that question. Today, you're going to hear from our expert panelists on how startups can protect growth without sacrificing user experience, how to build KYC journeys that flag risk in real time, how digital footprints can detect fraud invisibly, and how to reduce fraud while lowering onboarding costs. But before I get into it, I want to introduce our amazing panelists. Today, joining me, I have Nida Sattar, Product Director for payment and current accounts at Allica Bank, which is a UK-based fintech which banks SMEs. Prior to this, Nida started her career at JP Morgan before leading the international payments team at UK fintech Clearbank. I also have Shaun Puckrin, Chief Product Officer at UK payments fintech GoCardless. Shaun joined GoCardless in April from checkout.com, where he's SVP of Product. He's also held positions at issuer processor of Fred, PropTech Nested, and at payments processor WorldPay. Also joining me, I have Adrian Jenkins, General Manager of EMEA at SEON, which is a provider of fraud prevention and financial compliance solutions. Prior to that, Adrian has previously held roles at cloud technology company Oracle and at Finego, a SaaS fintech focused on regulatory compliance. And last but not least, I have Dmitrii Vasin, Head of Compliance Products at Money, which is a business account and tax app for small businesses and freelancers. Prior to that, Dmitrii has held roles at UK fintech super app Revolut and Challenger Bank Multipass. Yeah, I'm really looking forward to hearing from our panelists. But just to do a little bit of housekeeping before I start, there's a Q&A box on the Zoom channel, which should be right at the bottom here. So please do feel free to send in questions, and we'll get to them when they're appropriate in the conversation. And yeah, please don't be shy. This goes to our audience members and our panelists as well. We want this to be as interactive and as possible. So yeah, looking forward to a really lively conversation. So to kick things off, so as I mentioned before in kind of the recent cases that I cited, yeah, both Monzo and Starling were criticized by the FCA for failing to scale their fraud controls alongside customer growth. I'm interested to hear from our panelists on a more kind of general basis, just to sort of introduce the topic. Why does rapid growth introduce new risks, especially in fraud? Dmitrii, do you want to kick us off here?
Yeah, one of the examples I have and we encounter and fighting against this issue is newly established businesses and fraudsters. It's quite difficult to distinguish them. So when I'm a fraudster, I need an account to receive fraudulent money, and it means I have no business, I have no evidence of this business, and I open an account. And at the same time, if I'm a product manager and decided to open my consultancy thing, I create LTD and go, and I also have almost no evidence of business of my newly established business. So it's kind of one of the difficulty we're fighting.
Does anyone would add anything to that as well?
Yeah, no, I think that's very, very valid question, very good question. And some of the examples you shared, I'd like to touch on those a bit in my response as well. I think generally, to your question of why rapid growth introduces new risks, it effectively rapid growth is widening the attack surface. So criminals might especially be looking at companies like this and actively targeting them because they might think there are vulnerabilities that they can exploit
Mhm.
there. And that's why fast growing companies can be targeted in that way.
Mhm.
And then some of the recent instances that you've shared for AML failings, that is an example of that, but it's also an example of thinking about data completeness and data accuracy and having checks inbuilt into the system that look at these indicators, right? So if you're looking at new cohorts of customers, new types of
Mhm.
customers, potentially business entering new markets, launching new features, it's thinking about all of those and thinking about how that might interact with systems that you've set up today and how those systems might not be able to quickly catch or be set up in a way where they can effectively catch unfamiliar fraud vectors that haven't been seen for that business before. And then generally, the point around data is very, very valid here. I know we're going to touch on that later as well, but there's always in product management, there's always the aspect of technical debt, a bit of
Mhm.
regulatory debt, right? How do you scale fast and think about how you're not introducing technical debt that can actually then impact you in a regulatory way? I think that is key to this discussion.
And how I'm curious to hear from our other panelists, like how have you kind of balanced that pressure for rapid onboarding with kind of robust risk assessment
I
as
think
well?
just sorry, building on that point, I think it's as the reason you're a fast growing company is because you've managed to scale quickly. You've probably done that by taking a good approach to how you're finding product market fit, which means you're not over investing in your product. You're trying to work out what is what your customers like, how that works. And then when you hit the product market fit, then you expand. And you may have taken shortcuts to do that. So there might be manual
Yeah.
processes, there might be all those things. And so when you scale, suddenly that becomes difficult. So it's not about not incurring technical debt, but it's recognizing when you have, and then you have to pay the piper eventually on that stuff. And so making sure that you've kind of pre-worked with your business to say, hey, look, if we hit these scale and hit this thing, then we have to go back and automate some of these processes or fix some of these things. So it's not about that it was done wrong in the first place. It's just that you've got to recognize, where
Mm.
you are taking shortcuts to find product market fit, and then being able to address that as you go forward. And that's tricky because there's always another thing that your business wants to go do as a result of that.
Mhm. Mhm. And how would you say you've kind of balanced that pressure for, obviously rapidly onboarding customers and still having those kind of risk checks in place?
I think it's usually the product person that kind of needs to be in the middle of that trade.
Mm.
I think it's about clearly articulating but not over scaring the business about what it is, what the implications of these things are, because everyone
Mhm.
understands it's something they need to do. It's a question of like, what are the potential impacts of the business? What are the risks that we're willing to take? Do you have a risk framework that allows you to say, hey, look, once we tip over this level of risk, we need to make these provisions? So I think it's about clarity and articulation within a business as to what risks they're willing to take.
And Adrian, was there anything you wanted to add to that? I saw your mic go off for a moment.
Yeah, it's interesting because following on from what Shaun's saying, startups quite generally, they initially gain success because they're doing something unique, right? And maybe different, that has a very compelling value proposition, and they kind of gain traction and growth off the back of that. And that one thing they do very well and tend to be focused on that. They make decisions, as Shaun said, generally, which is, some things we'll build ourselves because we can get by for now. But ultimately, depending on the dimension or dimensions of scale, so maybe they're getting, scale through just more customers. Maybe they're looking to expanding to new regions. Maybe they're launching new products, right? The business becomes more diverse, and
Mhm.
therefore preventing fraud from those various lines of business and services also becomes increasingly complex. And that's quite often where we first sort of engage and speak to our customers, right? Where they've got to that point where they realize that the decisions they need to make now are ones that will have a profound effect on their ability to continue to scale without creating friction, right, in the future as well.
And I wondered, one of the big, I guess, developments recently has been the implementation of the new APP fraud reimbursement rules that came into force, I think, October last year, which means that most fintechs are now liable up to 85K per case. I wondered, how has this kind of changed fintech's approach to customer acquisition and onboarding since implementation?
Yeah, I'd say for us, it hasn't strictly changed much because at the end of the day, we didn't want this to occur anyway.
Mm.
And you know, for us as a company that's trying to encourage people to move to bank-based payments, it was always part of our DNA to kind of be able to build a proposition that gave customers and merchants confidence in it as a rail. And so for us, it didn't change our behaviors, but it reinforced what it is that we wanted to provide. Right?
Yeah, I would add, I think generally in the banks in the UK, I think it's a good thing in a way. So it doesn't change the onboarding approach, but it's a good thing in a way because it does mean that everyone has to follow similar sets of rules, and it does mean that ultimately does uplift some of the compliance, and control framework that exists in the industry as a whole. The other thing around that is, I mean, varying degrees of success on this, but there were some levels of education campaigns, although I believe more needs to be done in terms of customers themselves understanding that the risks that they might be under and the new types of scams that are coming in as well. So I think more to do here, but generally I would agree with Shaun that it doesn't really change the onboarding approach in that way, but it does change some of the controls we think about.
Yeah, and not only controls, but also it's quite a nice North Star metric now. So before APP regulations, it's of course we measured fraud and level of fraud, but it was a bit more difficult, and now it just kind of helps to focus your effort on and improve what you already had.
When you say North Star metric, as in like, yeah, how would that look like in regards to
Okay,
that?
yeah. When I say North Star metric, but it's a good indicator. So now companies and financial institutions, we pay real money to reimburse fraud and send contribution to Sending PSP, which gives a clear understanding and measure of fraud on your platform and what's happening, and to reinforce what you already have on the platform.
All right. So it's like a measurement of how much fraud is occurring on your platform, right?
Just one of them,
Yeah.
but now it's the same across, as Nida say, across different financial institutions.
Yeah. Okay.
I think on this is a really good example as well of how technology can play a really important role, and I think also as well we've the panelists have already mentioned about data and controls, and it's not like most of these companies that are experiencing APP fraud didn't have those things in place. But what is perhaps more is how do you go further upstream to prevent that from happening, right? So you're aware that there are potential parties on your platform that are at risk of potentially going to do this, and so what it highlights is it's the completeness of the signals that you have in order to be able to make those decisions, right? To be able to identify as early as possible that type of fraud is going to happen or likely to happen. And that's where technology, plays an increasingly important role, where, it's the completeness of those signals, and ensuring that, whilst a lot of companies will have various signals and various controls in place, they're not necessarily always complete. And that's the bit that obviously those incremental differences can have a massive impact on specific fraud use cases as well.
And out of interest, what are the ways that fintechs can future-proof their compliance networks as they scale? Does anyone want to take that?
Yeah, I can give it a try. I guess, I mean, that's quite a broad question, right? But it does need to be considered I guess, in an end-to-end manner. So you're looking at it from all the way from before you onboard a customer throughout the onboarding journey, and then you're thinking about actually what the indicators are in life. So what can you do in terms of those indicators? It's not a one and done type of situation. It is an evolving, frequently changing kind of customer, I guess, behavioral pattern as well. And that could be two types of things. That could be first-party fraud, i.e., you have onboarded a customer that is fundamentally a fraudster, or it could be a customer that is susceptible to fraud, right? So they can be targeted in different ways, and you have to think about how from the beginning of the journey throughout in life, what controls do you put along the way, and what signals do you pick up along the way to be able to recognize all of those? Not an easy thing to do by any means. And then obviously it does differ based on the types of businesses that you onboard, or the types of customers that you onboard, whether they be retail or different types of SMEs. What user profiles that they have, generally what target segments are you going after, and then there's also a huge amount of open banking data plus other data available now that can be utilized within that journey to pick up those signals. Lots of good fintechs doing work on having consortium-based data available that participants like ourselves do use and can use. But I think we'll go into this later as well. There's a huge amount of unstructured data through a lot of through the customers that you have on your books, and through the customers that you onboard. How do you effectively use that that unstructured data through conversations that you're having with them, emails back and forth that you are sending with customers, or panelists that they might use, and then forming that kind of full really risk score and fraud picture for your customers. No, that's very broad, but happy to jump into any themes.
And one thing I want to add to what you just said is also about business strategy of your company, because naturally different companies can acquire different type of profiles, starting from SME or individuals, but even within SME segment where we work, based on how you acquire them or who you're targeting is completely different, and you just need to understand and see what their potential patterns, and use them down the road. It's also quite important kind of entry point to the thing.
Shaun, is there anything you want to add to that?
I mean, so 100% agree with everything that's been said. I think there's a really hard job to do of building the frameworks, and the point about this is not just onboarding, this is in life. And if you reference the Monzo case, I suspect their onboarding kind of would have caught that, but this is a problem they inherited and in the early days, and it's kind of stuck with them. I think the other thing I would say is that there's all the hard work you can do, and we all kind of think about doing this internally with all the data we can get our hands on and building those systems. But there's also just kind of talking to the ecosystem, understanding the issues that your suppliers or the regulators, the others, they have a wealth of information, and they're seeing a world as well. So keeping those dialogues open with the ecosystem, with your partners, is also like a really, really good way to kind of make sure that you're keeping on board on what's happening, because we're all smart, but we're smart if we share that information as well.
And beyond, say, like initial kind of KYC check, what kind of ongoing monitoring would you say is important to implement, and what technologies do you use for that?
Yeah, I think this is so all of those. I mean, there's regulatory requirements here anyway, but all of those checks that you do on onboarding need to be done on a periodic basis, right? So that's really important, and kind of building a system where that isn't some manual thing that it kind of kicks in. Like the more you can automate that, the better, right? That's often hard, and it's often not the focus when you're starting, because you're trying to get everyone in the door. That kind of periodic review is something that you kind of need to build in. But then it's much more about the behavioral things and changes in behaviors that you're looking at, right? So, is that company that was doing, said it was a gym and was doing, gym-like payments, but now is, doing £50,000 payments. Like those are all signals that you need to be kind of checking, looking at. And, this is where, we'll get into it, I guess, but, where things like machine learning can really kind of kick in, because you can automate and, find ways for those signals to come from the system, as opposed to having, again, rules-based approaches that you do, which is still great and still really useful. But these are the new ways that we can investigate the data that we have at our fingertips.
So on our side, when you onboard a customer, you have one set of information, and when a customer starts using your accounts, it's another type of information. Is the biggest difference now. We know something about the devices. We know about transactions a lot, and yes, it's about looking for patterns and for changing device fingerprint, for example, or something suspicious in transactions in terms of volumes, frequency, or maybe direction and nature of these transactions. And this is what's important to do. You cannot do it during onboarding, but it's important to do when customer already using your services.
And Nida, I could see you kind of nodding along during Shaun's answer. Was there anything that you would add to what they were saying?
I think agree with everything that's been said, right? So, for ourselves and industry participants that we speak to, they do use a mix of not that it's a regulatory requirement anyway to do transaction monitoring, but how do you enhance that transaction monitoring to give you effective responses as opposed to just a host of false positives continually that don't mean anything in isolation. So using a mix of behavioral biometrics, device network intelligence, any information that you can get from consortiums, all of that does help. I think the other thing that we really think about for our customer base is we are primarily a relationship-driven bank, and so every one of our customers does have a dedicated relationship manager, and that's a really good source of information as well, because effectively the relationship manager is meant to know the customer really, really well, understand their behaviors, understand what's going on with the account, and can flag and look at things that might look suspicious or not in line with general customer behavior.
So I'm curious what kind of behavioral changes in customers might indicate risk, and how do you kind of detect that without creating friction for legitimate users as well?
Yeah, so I mean, it depends, right? Again, it depends on the type of fraud, and it depends on whether your customer fundamentally is the fraudster or not. So we would look at things like, if the customer stated during an application process that their turnover is going to be an X amount, but through, in the actual usage of the account, I think this is the point that Dmitrii raised, which is you've said one thing in onboarding, but during an actual usage of the account, you spot anomalies in terms of, you'd said this turnover, but either, it's probably 5 times higher. Again, could be a mistake, but usually not. You've said that you would only trade in XYZ countries, but you're trading in 15 other countries that are, say, on a FATCA list. Those are sorts of indicators that would point to that's not really behavior that we expected the customer to be doing. And then if you think about, say, account takeover, behavioral biometrics play a huge role in trying to identify those cases. So are the keystrokes different? Have they logged in from a new device? Have they tried to pair a new device? Is the IP address different than what they usually does? And then pairing it with behavior on the actual account. So have they added lots of new beneficiaries and started making a high volume of transactions? So looking at velocity patterns there as well. But I think fundamental point is you have to connect the signals. In isolation, they wouldn't tell the full story.
And on top of this, just another example of changing pattern behavior. When someone is transacting with companies, and after that have suddenly started to receive more individual payments from individuals, for example, it's just another one of many potential signals here.
And Dmitrii, I think you also mentioned in our kind of pre-panel discussion as well that communication between kind of different financial institutions is important as well in order to kind of prevent the fraud at source. I wondered if you could tell me a little bit more about that. Is there kind of an issue, would you say, currently in the way that fintechs communicate with each other regarding fraud at the moment?
Yeah, when I mentioned this during our conversation before, I meant that it would be great to have a system where, for example, our customer who is potential suspect, we receive payment, let's say, from Allica Bank. And we see that it's something weird. And in this case, of course, we can go and check our customer and ask about evidence, some documents, and now as these days it's quite easy to fabricate almost everything, like your even passport, right? And I'm not talking already about invoices and something else. It would be nice in some cases to have a quick access or contact with potential victim and ask, look, it's quite suspicious. Is it really you're paying to this company who claimed to doing something? Of course, maybe not directly, but quick channel communication through sending PSP or through sending bank. It would be, from our point of view, it would be really a massive thing if it would be possible to build something like this.
Why isn't there, do you think?
It's a classic network problem, which is, you know, at the end of the day, some people have information, there is value to that information. So do I want to monetize that? Do I benefit? You know, so it's a classic, you know, like who is the central point to do that? You are starting to see, you know, bilateral agreements, particularly between, you know, acquirers and issuers, where they are willing to share their fraud scores. And so, hey, look, here's a transaction that's coming through. I've scored it like this. What do you think? So you're starting to see that happen. You know, I think that's definitely a positive sort of move. But like, if we wanted to be more structured, I think, you know, like potentially open banking and things like that have, you know, a better way of doing that. You know, we've seen the schemes have things like VMAS and Match, which are good. But you know, still only talk about, yeah, they're pretty static lists that you know, are about, you know, merchants, that potentially fraudulent merchants, not payers and individual transactions. So I think, you know, it's one, it's hard, it's two, it's valuable information, and there's a asymmetry within the ecosystem as to what the value of that information looks like.
I think this is also a void that technology vendors can fill quite effectively. And it's about choosing the right partner, because obviously, you know, ideally you want to have kind of lookalike, you know, companies that you can share data with. But what's interesting, like, for example, like our 5,000 customers all get to basically benefit from the consortium data that we have. And so, you know, that can be like specific to a particular industry, like such as fintech. But actually, what's interesting is we quite often see certain fraud vectors start in one particular industry, maybe a higher risk industry. And quite often, you know, once that's proven to be successful, you see that start to appear and replicate in other segments quite quickly. So, so I do, like I say, I think, you know, the challenge with having a lot of sort of tools maybe to help you to do in-house fraud detection, it might give you the signals that, you know, ultimately come up with an answer, but that's still potentially limited in terms of, like, what if you get it wrong, right? You know, you're still creating friction. So being able to kind of get to the point where you've got that, and then being able to say, has anybody else seen this before, right? This profile definitely gives an element of additional accuracy and certainty over, you know, what decision to make as a result of that.
And on the kind of topic of tools that you can use to reduce fraud, we have a question from the audience from Dan Feeney. Hope I'm pronouncing your name right. He's asking, how well is confirmation of payee, aka IBAN name check, working to reduce fraud and misdirected payments from sender to receiver as real-time rails grow globally? Does anyone on our panel want to take that question?
I mean, it's definitely helping. I mean, it's also introduced friction as well. So yeah, and I think what you've seen is, from the initial implementations, you know, we've seen a lot of improvement in that thing. So like more fuzzy matching and kind of more, you know, better ways of determining whether that works or is a match. And I think consumers are actually starting to get used to it as well now. So I think they recognize there's a pattern that they need to work through. So it's definitely helped, and we see that in our numbers. I think it's one tool amongst many, though, right? And I think, you know, we can leverage other tools, other information to kind of support that. So I think it's you know, a lot of this is you're using underlying data to then, you know, how much of that triggers a challenge, right? Like, so, it's about kind of using all of those signals to then say, okay, when do I feel this is uncomfortable? When do I want to represent friction in the journey? Because I want to check some more information. So it's definitely helped. But it's another tool in the toolbox.
Okay.
And I would add to that to say, especially for banks like us, it does differ per product. So, for example, if you're using savings accounts, banks would traditionally commonly now use confirmation of pay as a pretty good control check of payments staying within the closed loop network as opposed to being third-party payments. So that's one way of doing that. For third-party payments, again, I would have loved to have some numbers to show, but definitely see that it does impact. It does make the customer at least think twice if the name doesn't match, and sometimes that is what the customer needs, right? That kind of thought, that trigger that says, oh, this isn't quite what I was expecting to see, and maybe I should double check that I've entered for whatever reason entered the details correctly, or double check that the details provided to me are correct.
Dmitrii, is anything you want to add to that?
And also, it could be a signal for us to launch extra questions to customer and clarify what they're doing, why they're doing. Maybe they've been currently in vulnerable position and they need to send money quickly. So again, it's just one of the tool. It gives different signals to customers and to the system as well to launch extra measures in case customer still wants to proceed. And we believe that it's unusual transaction and unusual pattern.
Thanks, Sam, for that question. I just want to shift the conversation a little bit more onto the topic of the moment, which is AI. So obviously AI is making fraudsters more intelligent, but at the same time, companies can also use fraud, right? Use AI, right, itself to become to tackle fraud more intelligently as well. I wondered if we could go around the room and kind of hear, I guess, some of the best practices of how you're using machine learning or AI to kind of spot fraudsters with kind of invisible detection. Does anyone want to take that question first?
I can start, and we utilize different AI tools, machine learning tools, LLM at multiple stage of customer journey. And probably it would be difficult to list all of them, but I will give just a few examples that I like. If we talk about onboarding journey, and what's the typical issue? If you ask too much particular customer, a good customer can just go to another company and open account with them. If you ask not enough, it will be difficult to score customer and you will stop their transactions more often. And if it's a good customer, you create some frictions. And the trick here is to ask, and of course, multiple companies, including ourselves, we're building decision tree, like kind of choose one option, another option, and trying to build all possible options to cover each company, each business situations. And quite often you have quite big decision tree and it still doesn't help you and doesn't help customer. But at the same time, if you take experienced FinCrime analyst or onboarding analyst, they can easily interview customer, ask questions based on previous context, request evidence which must support their story. And but you cannot do it for each customer. It will require a lot of manual labor, and it's where LLMs can really help. And we are using and building AI agents which helps to interview customer the way that we get information about the business, but asking questions that a real customer can easily reply. Just because what's the difference between fraudster who wants to open an account and a real customer? Most likely fraudster just doesn't have a real business. And the question how to ask something that a real business can easily reply, and it won't be a friction for them. But at the same time, a fraudster maybe just don't know or will provide like generic answer. It's just one of the way to collect and to gather extra signals you can get from the interviews. It's just one example. And of course, we have all the sorts of models after onboarding and during onboarding with core customers and assessing their fraud risk, money laundering risk, risk of being potential victim, and different models, different signals, different approaches. And for fraud scoring model, of course, we use information from the market, of course, ciphers, device fingerprints, etc., etc. We were doing a pilot with SEON as well, and now assessing the results. So a kind of all bits goes to a proper machine learning algorithms.
I think on the AI question, I just wanted to preface first that obviously with with the tools available now in the market that they are in the hands of effectively everyone, it does change the risk profile a bit as well. So, it has become a lot easier to do voice spoofing, invoice and document tampering, and that presents different types of challenges as well for banks, financial institutions, as well as EMIs in the market around what to do and how to catch those types of those types of documents. And of course, there are tools available in the market, but I think there is still probably way away in terms of evidence of are we actually capturing the newer techniques that fraudsters are now starting to use as well. So just wanted to preface that. Don't have an answer to that question, but did want to talk about that a bit. In terms of how we're thinking about AI, I think some of Dmitrii's mentioned a couple of very good points around, even using AI agents potentially to interview customers, but equally voice recordings is a good one, right? Where when you have that, you can effectively check against previous conversations that might have had happened with a customer and pick up signals of whether it looks like there's something different about this, or is it a fraudster trying to take over the account calling in as opposed to the customer themselves. And fraud itself fundamentally is a data issue. So by using that data well, you can actually uncover a lot, and you can risk score it in a way where you only surface that friction when that risk is spiking. Otherwise, you could effectively outsource some of the decision making in terms of rules and ML engines running to kind of a first level agent, and then have a human in the loop for risk spikes to look at, is this legitimate, is this not legitimate, and should we now step in and do something about it?
Shaun, something you'd like to...
Sorry, things that, so the other thing to mention about like having the machine learning models, we have a Protect Plus product, it's leveraging all the data. So I think that becomes table stakes, right? And it's really important that we have it. Two really interesting areas we're sort of evaluating at the moment is, one is, one of the things with AI is that the tool chain to develop and integrate services is completely changing, right? So, whether it's tools like Cursor or Replit or Base 44, so we're working on tools that allow us to be absorbed into those products, but that opens up completely new fraud vectors for us. And so we don't know the answer yet, but trying to understand how that might be exploited in fraud is going to be super interesting and something we're looking at. I think the other one is, we talk a lot about, let's say, digital channels, digital information that we have. I think AI also allows us to analyze the non-digital channels. So Nida was talking about the relationships with people. We have a lot of enterprise customers. Those can also be vectors for fraud. And so using call recording and analyzing emails and stuff, we can actually pick up on the fraud vectors in those conversations, as opposed to the vast majority of fraud is done by the sort of the weakness of the human link. And so using AI to analyze that is also a great opportunity to combat fraud as well.
Adrian,
I was going to say, I think it would be remiss of me being a technology vendor, right, to not talk about the AI topic itself. I mean, we're very lucky in that as a sort of fraud prevention solution, a lot of our decision making has kind of been based on machine learning for some time, right? So that's not necessarily anything new. What AI has really done, and where our customers are constantly challenging us for innovation, is around how do we help them with kind of three major impacts in their business. How do we do things faster? How do we do things more accurately? And how do we increase conversion, right, of either onboarding or other elements of the business, and they reflect normally the friction that's actually going on within the business, right? Between, say, marketing and the fraud team and so on. So where AI has been really interesting is how we've adopted that to help to make a positive impact, right, on those sort of three variables. So using it for speed of decision making in things like you know, what new rules should we be putting in place, right, around fraud? How can we you know, provide sort of next best action around investigation of either fraud or sort of AML or compliance? And those are the things that you know, where we're kind of innovating on the back of, you know, where our customers are demanding, you know, to make that biggest impact. And then for the fraud itself, yeah, I mean, absolutely. You know, you've seen probably numerous examples in the press of fraudsters being able to use AI tools to effectively bypass things like KYC and standard checks, right? So it's then again down to vendors like ourselves to be able to combat that, you know, with kind of, I guess, anti-AI sort of, you know, techniques. So, you know, the importance of things like liveness checks, right, at onboarding, you know, have become even more critical now, as well as actually the convergence of both AML and fraud signals to match the two together. So, yeah, like I said in one of my earlier comments, right, you know, not only do businesses, you know, fraud prevention becomes more complex for businesses as they scale, but I think just generally, right, the table stakes for most companies now, no matter what size you are, is fraud generally has just got more complex, right, because of AI.
And
Anything else?
Adrian mentioned a nice point about speed of making decision, and I just want to share one more nice thing we're using on our site. When customer is stopped or transaction is stopped and fraud with fraud suspicions, and fraud analysts are looking into this customer, and they are trying to assess whether it's real business or not, and usually, of course, they're looking for inconsistencies in their story and trying to reply the question, do I really trust this business? Do I believe that this business exists or someone is pretending being a business? So it's kind of a typical work of a fraud analyst who doing manual thing. And trick here is just to make sure a fraud analyst check all the stuff. And of course, we have instruction, we have SOP, but a person can just miss a lot of things. And here again, where we leverage LLM, which can help using this instruction, look into the customer, create proper summary and highlight real discrepancy. And for fraud analysts now, it's much easier and faster to look in particular customer and make decision. And we are making sure that they're not missing any piece of information which manually, when you're looking into profile, open different tabs, can be easily missed just because maybe your title looked into another customer. And now we're providing nice summary of what, based on our instructions, the same instruction as analysts should use when reviewing accounts, what they should do exit checks. And we see that it helps with quality of review and with quality making decision, including not stopping good customers. So for example, someone looked and now, okay, yeah, it's a good customer, we allow, we believe, or we request something extra. At the same time to stop and prevent some fraud as well.
And I want to move the conversation on to kind of keeping keeping the cost of preventing fraud at bay. But before we do that, we have another question from Dan. He's saying many banks and FIs complain about social media companies causing more fraud due to lack of identity proofing, as they are not financially regulated. Is this just a finger pointing game? Would anyone here like to take that?
I think it's a very interesting question. So two things really to consider here, right? Take the point that they're not, regulated in the way that banks are. However, we do find that a lot of our customers do effectively get scammed because of individuals that are using these social platforms. That's one. The second one is around when these cases do happen. Of course, financial institutions do have liability to customers, especially when it comes to APP now. But even before APP and mandatory reimbursement existed, we did, banks did look at cases on their own merit to identify whether reimbursement should be given or not. And and you don't have anyone else to share the cost with on the other side, even though the scammer in this case might have come from one of these platforms. And I'll share a personal example. I have an issue with a well-known airline at the moment who owe me a refund, but aren't refunding me. So anyway, so I raised a bit of a complaint on Twitter to say, or X, to say you haven't, you've rejected my claim. What's going on? And within 30 seconds of putting that post out, I had about 5 or 6 different companies, different accounts claiming to be that company, saying, can you send us your email address? Can you send us your case reference? Can you send us your name and phone number? And we look into it for you, right? Now, they make it look really, really legitimate. But of course, if you go into the handle, you can see it's not the company that it's claiming to be. But there are people that aren't necessarily, if you don't work in fraud, don't work in financial institutions, you miss that. And I think that's the challenge over here, which is, it's not the company itself. It's the fact that there are scammers operating on this platform without really any without any, and we have no recourse either to that situation.
Would anyone else like to chime in on this spicy topic?
I mean, at the risk of just sounding like I agree, I think the issue is that they are becoming more and more an attack vector, and there is no, and it's not so much that sometimes they deal with it, sometimes they don't, but there is no dedicated channel or sort of way to address these problems. It's all very individual instances that you can manage through, and I think collectively we're not addressing these issues. And right now there isn't a massive incentive for the platforms to want to fix this, and so because we are regulated entities, we are held to account. There is less account there, right? Now that we can deal with it, and I'm not sure how much finger pointing has gone on, but I think we feel like there's definitely better ways to address this collectively.
So would you say that fintechs are kind of shouldering the blame onto social media companies?
I think it's at the end of the day, we are liable, right? They are not. So that's just the fact of how we're constructed, right?
Yeah.
And yes,
go ahead, Dmitrii. Sorry.
Okay, and from my point of view about social media, so we take one of the big network social platform. Of course, they might help us doing something on their side, but at the same time, fraudsters always will find a way how to get information from customer or how to trick them. Just in old times, it was over phone and messages. Now it's on social platforms. So it's kind of, yes, they might help, and it's good that there are some initiatives. For example, at Meta, at Facebook, they are doing improving their fraud controls and started sharing some. At least I heard about this, not with us, but they're starting to doing some projects, which is good. At the same time, if they close this thing, the fraudsters can go to another place and find a way how to extract this information. So it's fraud prevention. It's not only about this. It's more broad thing, and we need to think about more controls. And again, yes, collectively, it's a key word here.
Adrian, is anything you want to add to that?
Yeah, I mean, just picking up on what the other panelists have said, it's not like the technology doesn't exist, right, for social media companies to be able to detect that there are scammers on their platforms. It would seem, despite them not having perhaps a regulatory compliance angle to it, there's definitely reputational risk. But I would assume that someone in their business has made the decision that the revenue gained from the advertisements, right, that some of these scammers give them is probably outweighing the risk of damaging their reputation. It would appear that way, right? So I'm sure there's a lot more that could be done to prevent those types of vectors happening.
Yeah, no, it's interesting seeing that dynamic kind of play out. We only have 10 minutes left, and I did want to talk about, I guess the kind of inherent costs that come with keeping fraud at bay. I wondered, I guess for our kind of startup founders or operators in our audience, what are kind of, how can startups and scale-ups choose kind of cost-efficient tools and tactics for fraud prevention that will scale as they grow? Like, what are the kind of key metrics that you guys use to make sure that you're getting like the return on investment that you really need? Anyone wants to take that?
Yeah,
Nida.
I can start. I think, you know, as a younger bank and having gone through this journey a bit ourselves as well, I think it is very key to think about mapping your risk to the growth stage that you're at, because it is very, very individual to the type of company you are, the segment that you're going after, the customers that you're going after. So, for example, you know, if you're only going to operate in a single country like the UK, you probably don't need to have 20 tools implemented for day one, and tools that might focus on, you know, say international screening might be really, really good at that. You probably don't need all of that. So you have to think very clearly about the risks that exist for you at your current stage, but also with a view to the future, right? Don't just go with something that's going to probably cover you up to, say, you know, 50 customers for a year, and then beyond that you then have to go out and go get something else. So do think about that kind of future strategy and where you think you might need to supplement some of the tooling that you have. Obviously think about picking vendors that can support you on your growth journey, that might be trained on your fraud mix. So, you know, early days we found quite a lot of vendors that we were speaking to were you know, better trained at retail types of customers, whereas our business model was different. We were going after SMEs, and so we needed to pick the right tooling to allow us to really pick up the risks that exist within that particular SME segment that we were going after, not just broad, you know, SMEs or micro SMEs. The other thing to think about, I think it's been mentioned a few times, is consortium data. So, you know, that is extremely, extremely useful. Think about how you can get that consortium data from sources such as, you know, Cypass exists today, but there's plenty of others that do exist as well. And you might be able to get good data from them. And then lastly, I would say, you know, think about tuning some of the tooling that you have. I think it's quite tempting sometimes to think, oh, I'll just add one more thing to the tech stack and that might give me what I need. But actually, what you do have probably, hopefully, is good enough, and think about how you can tune that and use that better instead of going out and adding lots and lots of tooling and then creating lots of manual processes to manage those tools that you have already in place. In terms of ROI, I mean, I was thinking about this. It's a bit of a tough one, but, you know, generally, you know, the business case over here, in my mind, is quite simple. You know, you have to effectively come up with the payback period, right? So even if you look at APP fraud, you've got say one case can cost you 50% of the 85K, right? If the tool is going to cost you 40K a year, that's kind of a no-brainer, right? Even if it helps you catch that one case, you've already made a return on your investment. So think about it in that way around fraud avoided, you know, based with compared to recoveries, operational costs saved, and then divide that by the total solution cost that you're adding.
Yeah, that's all really, really actionable advice. Does any of our panelists would add anything to that?
I think sorry, Dmitrii, go ahead. I think there's some like just I won't say boring, but kind of like underlying things that you need to think about. And I think so, you know, tools are rarely the answer to the question. They're just kind of parts of the solution. And so making sure you build yourself in a way that allows you to adopt these things is really important. So whilst you do need to iterate quickly, you know, actually building great architecture, making sure your data's in a good state. You know, your machine learning models won't work unless your data's in a good state. You know, being able to introduce new data is a lot harder if you don't do that. So thinking about like what are the non-negotiables from a good architecture perspective that allow you then that flexibility in the future, whether you go to a new country or, you know, adopt a new vendor. And then the other thing I'd say is you know, making this everyone's problem and culture in the business, right? Like, again, it sounds boring. It's not like the cool thing about machine learning, but actually recognizing that everyone in the business has a role to play in this and building that into the culture of your business really pays dividends in the long term, right? So like, because it doesn't just be the job of a few individuals within the business, it's everyone's job to do that. You know, you catch a lot of fraud and you get better products if everyone feels it's their responsibility to do it.
Dmitrii, is anything to add?
Yeah, just I wanted to share almost the same thoughts about tools. So yeah, on the market, there are a lot of different tools. One tool can cost 50K a year, another one 100K, 150, and some of them similar, some of them not. And ideally, of course, as someone who is responsible for fraud prevention, of course, I want to buy all of them in order to minimize fraud. But of course, it's not viable, it's not feasible for the business. So it's quite important to understand what type of fraud you have and find just right tool, maybe test more tools, compare different tools. And for this, as Shaun said, it's quite important to keep data in a proper state in order. And because we're talking about compliance, anti-fraud, and some of the data we receive from fraud analysts based on the process, they label something, they leave their thoughts or judgment about particular customers, and the question how to minimize your cost is to keep it quite structured and in a well shape. And after that, it will be easy to test other tools, and tools will be much more effective in terms of how they catch different patterns and what signals they can find in your data. From my point, it's quite important thing.
Amazing, amazing. So we have, I'm seeing now, 4 minutes left. And just to kind of round things off and have a kind of closing question, I want to come to each of our panelists and ask them to kind of look into their kind of proverbial crystal balls and see what I guess would be the next kind of major challenge in fraud prevention. Adrian, if I could come to you first, I know you were going to chime in on the previous question, but yeah, looking ahead, what do you think will be the kind of next major challenge in fraud prevention that the industry really needs to start preparing for now?
Right, crystal ball time. Well, I think probably consistent with a lot of the things that we've already talked about. The fact that with AI and other technologies, everything's becoming more complex. So for me, I think the future of fraud prevention and detection is really about adaptability, flexibility, and foresight, and moving away from more of a reactive measure. I think if history tells us anything, kind of related to the previous topic actually, is that many companies, as they've scaled, tend to end up treating fraud with a whack-a-mole type approach, right? It's like, oh, we have this problem today, here's the solution to that. Oh, we've got another problem tomorrow, there's another solution for that. And before you know it, you've ended up with a portfolio of different solutions to ultimately attack fraud generally in your business, right? So I think that's definitely something that is going to be more important in the future, is to work with technology providers, fraud prevention solutions that can be adaptable and flexible for your business, right, and where you're growing as well.
And Nida, very, very quickly.
I'd echo Adrian's thoughts on that. Personally for me, AI being massive opportunity for general software development and product development, but at the same time does pose quite a lot of risks on the fraud side. So I'd say that is probably our biggest one.
Shaun or Dmitrii, you have around.
I mean, not to go down the AI bucket, but one area that's really interesting to us is like if you assume that agentic commerce happens, and so there's like agents with it, how do you stop that being used as a vector for fraud? I think that's going to be like super interesting. So yeah, how do you set the policy? How do you set liability? All that is going to be very interesting.
Dmitrii?
Yep, just the same thought that tools now helps not only us but fraudsters and all the AI tools. It could be quite a big threat, and we need just to find a way how to be smarter about this.
Oh, yeah, great. There's all some really, really actionable advice from our panelists. We have 1 minute to go now, so I'm going to thank everybody for taking the time to attend this Sifted Talk. Thank you so much to our panelists and our lovely audience as well. If you're hungry for more Sifted Talks, we'll be holding our next talk on how to build compliant AI from day one on the 17th of September, which will be moderated by my colleague, Kai. You can find more details about this on sifted.eu/talks. But until then, it's goodbye for now.